Well, thanks everyone for coming today. My name is Jeff Swainson. I'm the CEO of Simply Solventless, ticker symbol hash. Obviously last year we were here and we love the conference here. If anyone wants to connect with a one-on-one or come discuss our business after the presentation, please just come over to Ballroom E. So as you know, our ticker symbol is hash. Our mission is to provide exceptional and personalized cannabis journeys to discerning cannabis patients and consumers. And our vision is to be the most profitable cannabis company in Canada through customer connection and prudent capital stewardship. And on the capital stewardship, really, we've built this business for very low capital compared to a lot of our peers. And so here's our one-pager. So if you come and see me for a one-on-one after, we can give you this. This is kind of the one-stop shop for who we are and what we're doing. So ultimately our strategy is organic revenue growth and opportunistic acquisitions. And so on the organic side, we've built 3 brands internally, Astrolab, Fruity Hootie, and Status. And then over the last 18 months, we've completed 4 acquisitions. So we started with the acquisition of a small brand called Lamplighter, and then we segued that into the acquisition of a licensed producer in Ontario called CanMart Inc. And then predominantly B2B and tolling pre-roll manufacturer called ANC Solutions in Edmonton. And then vertically integrating into cultivation, we acquired Humble Grow Co., previously Delta 9 Biotech, in February 2025. And in terms of results, we've, in Q2 2025, annualized, we achieved 52 million revenue, 12.8 million annualized adjusted EBITDA, and 8 million annualized normalized net income. We have approximately 20.3 million of working capital. And as noted, we've completed 4 acquisitions over the last 18 months at an average acquisition adjusted EBITDA multiple of 1.35. So we'll get into a little bit more detail on the acquisitions and how that multiple translates into revenue and EBITDA. But clearly in the Canadian landscape, there's a lot of opportunities for acquisition. And in terms of our value proposition, it's changed a little bit over the last 6 months, of course. So one of the unique things about us is about half of our revenue is CPG and half is B2B. So on half of that revenue, we don't pay excise. So as a corporation, our overall excise rate is about 16%, compared to our peer group at about 28%. Of course, we've achieved significant revenue growth from 2023 annual to Q2 2025 annualized. We've increased revenue by 643%. And then in terms of fundamental and multiple analysis, we do have one of the higher net incomes. In Q2 2025 was about 15% normalized net income as a percentage of revenue. And we're trading at a 2.1 time adjusted or enterprise value over adjusted EBITDA multiple. And so we are trading at a significant discount to our peers. And our peers, we look at them and we look at this group as some of the brightest cannabis companies in the space. We have a huge amount of respect for these companies, and these are the companies that we believe are very well run and that we aspire to be like, essentially. And so overall, in terms of our CPG business, we started as a solventless company, obviously Simply Solventless Concentrates Limited. And so our ethos was solventless concentrates, pure, potent, terpene-rich products. Of course, with concentrates being less than 5% of the market, we, over time, have expanded into product categories such as infused pre-rolls, vapes, whether it be 510s, all-in-ones, and even beverages and edibles. And so we have a suite of brands across all major product categories other than dried flower. Astrolab is a fully solventless brand. Fruity Hootie is, we call it live rosin amplified. So we basically bring the full spectrum experience to flavored distillate products and flavored liquid diamond products. Royalty is a hydrocarbon concentrates brand, so live resin, shatter, wax, things like that. Lamplighter is an ultra high potency distillate and liquid diamond brand. Zest is pure liquid diamonds. And Status, which is really taking off, is essentially triple infused blunts that are keef coated with glass tips. Just some of the most beautiful blunts and pre-roll products that you'll find anywhere in the country, as well as all-in-ones. And so at a high level, our infrastructure, we have about 157,000 square feet of licensed space across 4 facilities. Our infrastructure is only utilized to about 25% of capability. So we have a lot of revenue growth opportunity within our existing infrastructure. We have approximately 32 million of net assets, and our gross revenue, as noted before, is about 52 million, with about 12.8 million of adjusted EBITDA annualized. Our facilities are in Calgary, Edmonton, Winnipeg, and Toronto. And so as you can see in the bottom left, over the years we've grown from a solventless company to, of course, doing formulations, and then with CanMart Fulfillment, A&C brought pre-rolling in. Humble was our first foray into cultivation. And then, of course, we do white label, such as the Sluggers deal, which I'll speak to in the next slides. And so in terms of revenue growth, the presentation isn't going to be long. It's pretty succinct. And of course, one of the core areas for us is revenue growth. One of the ways that we're looking to achieve that revenue growth on the organic revenue growth side is entering new markets. So right now we're predominantly Alberta, Saskatchewan, Manitoba, Ontario, New Brunswick. And we're working on deals to enter BC and the Maritimes, Newfoundland in particular. BC is the 3rd largest market with about 15% of the national share. And so that'll be a big incremental revenue opportunity for us. And another core area where we see revenue growth opportunity lies in our sales and marketing spend. So if you look at some of our peers, on average they spend about 5% of revenue as sales and marketing, and we only spend 1.9. Up until very recently, we only had 2 people on our sales team across Canada. About 3 weeks ago, we hired Emily Reel as VP of Sales, and then also 6 sales reps covering the entire country. And so we expect that that's going to help our CPG sales. And we're going to also deploy capital into marketing assets to make sure that those salespeople have the appropriate materials and brand assets to succeed. And then another core area of revenue growth for us is the Humble retrofit. So the Humble facility currently produces approximately 8,000 or 9,000 kilograms of cannabis per year. That's large flower, small flower, and trim. We're deploying approximately $2.5 million over the next 6 months into a retrofit. So the footprint's the same, the infrastructure's the same, but we're getting new lights, new dehumidification, and new tables. We're basically just upgrading the existing equipment, and we have a 2-year proof of concept that demonstrates almost 100% increase in yield. And so we'll have the same fixed cost structure. We'll almost double production, almost double revenue if the pricing remains consistent, and at a corporate level, to increase our revenue by approximately 17% from the retrofit. One of the good things is that of that $2.5 million, the largest portion is lighting, upgrading from high pressure sodium, which run very hot and inefficiently, to LEDs. The Manitoba government, actually, Manitoba Hydro, has a rebate program where we're actually going to recuperate more than 100% of the cost of the lighting portion of that retrofit. So all told, it's going to be more like $1 million, maybe $1.5 million. And so when you look at it in the context of our opportunities to generate revenue growth, deploying about $1.5 million to achieve incremental revenue of 8 or 9 million is, in our book, money well spent. And then, as I was mentioning before, approximately 55% of our revenue is CPG, so branded products in retail stores essentially, and then 45% is B2B and tolling. And so that 45% is things like Humble. 100% of the flower the large flower from Humble is sold to other LPs in Canada. We don't sell any of it in branded products. And then A&C has a pretty substantial pre-rolling and B2B business as well, of course, for tolling. And so that revenue is non-excisable. And we like paying less excise. And so if you look at our excise rate as a corporation, it's about 16% blended. And on average, our peer group's at about 28%. And we were, a year ago in Q2 2024, we were 43%. And so the diversification of our business into, pre-rolling and tolling and B2B and the sale of dried flower into those markets has drastically reduced our blended excise rate. And then in terms of acquisitions, of course, we haven't pursued an acquisition for about 8 months now. Back in February 2025 is when we closed Humble. We very much have a pipeline of acquisition opportunities that we're continually evaluating. But if you look back at our acquisitions, net of working capital received in the deals, we paid about $13.5 million for our acquisitions. And that's a mix of cash, equity, VTBs, essentially, mostly deferred consideration. We've added approximately 40 million revenue per year with those acquisitions, approximately 10 million of annual EBITDA, and all told, we've paid about 0.3 times revenue or 1.35 times adjusted EBITDA for those acquisitions. And so even, in a later slide and in the summary slide, you saw we were trading at a 2.1 times. Even at this low multiple that we're trading at, we're paying 1.35 times for acquisitions and turning it into 2.1 and hopefully higher. And so here is the multiples. And so what we're demonstrating here is just the average multiples in the industry and the average net income percentages. So in terms of normalized net income, Q2 we were 15%, which is among the higher of our peers. And of course, we're trading at a 2.1 times EV over adjusted EBITDA level, where average is 6.3. So we've demonstrated strong revenue growth in the past. We've demonstrated, that we can achieve profitability. We believe that we have good revenue opportunities going forward, and we also believe that in relation to our peers, we are fundamentally undervalued. In terms of our cap table, we have approximately 15 to 20% insider ownership, approximately 20.3 million of working capital, 115 million shares out basic, and 139 million fully diluted. And our team. So Ananth Krishnan, of course, we brought on, I'm not sure if you saw the news, from Aurora. He was VP of Strategy and Corporate Development there. He was there for about 6 years, was instrumental in an epic turnaround, really, is the only way to describe it, of a company that was in a very poor situation and is now a very strongly cash flowing business. Jeff Lawrence, our CCO, Murray Brown, COO, unbelievable at integrations. With the Humble integration, we actually, the business had approximately 120 people, and we had modeled that we could take it to 53 people and still have a good manufacturing process. And ultimately, we took it to 60, and then now we're at 48. So we're even below what we modeled, and in large part that's because of Murray Brown and his integration and operating capabilities. And our board, Bill McDonald is co-founder of Simply Solventless. Steve Bjornson, he's one of the very early investors or co-founders even of Vermilion Energy and very, very strong CA. Olin van der Lieden, about 6 or 7 years of experience at the CCO level in cannabis. And then, of course, me. So that's the presentation.